Alrighty, so in this video, I'm just going to be giving you the answer to why, okay? Just in a general sense, why does the market move the way that it moves? And to do that, what I'm gonna do is explain this concept of balance and imbalance, okay? So let's see, we have to understand that the market is moving from areas of balance to imbalance. Okay. Just so that it can establish a new area of balance. And this is the game that the market plays. It goes from an area where everything is perfect in a way, or equal, or actually, here's a good way to think about this. The market goes from fairness to unfairness back to fairness. Okay? That's another way to think about it. So, what do I mean by this? Let me go ahead and just illustrate this principle real quick for you. So, what I'm going to do is I'm going to draw a little bit. I'll probably draw it in white. Okay. So the market is going to go from an area of balance. It's going to look a little something like this. Now, I want you to keep in mind, all I'm doing is I'm drawing out a concept. This is not realistic, okay? I don't have market structure in here. This is just a concept. So the market goes from an area of balance just to create an area of imbalance to establish a new area of balance. Okay. And then next thing you know, if it continues to go in the general direction, now we have a trend on our hands where it creates another area of imbalance just to create another area of balance. Okay. Then we might get a reversal where the market comes up to create, let's just say, an area of balance in this region here. And then it may come down here to establish another area of balance to ultimately shift the direction of the market, right? From a downtrend to an uptrend and establish another area of balance, okay? And so on and so forth. So what I want to highlight here is this, right? Is this principle here, that the market is at any point in time, the market is somewhere in these regions. It's either in an area of balance or an area of imbalance, meaning that there's going to be a range where the market is, how do you say? Let me use a different color. There's going to be a range where the market is rather tame, rather fair, where buyers and sellers are interacting with one another, and all of these areas here are areas of balance for us. So just give me a second to really kind of mark these out a little bit. This is one of them, right? And there's a lot of different things I could call these. You know, if you come from like if you have some trading knowledge, you could call this might look like consolidation to you. Some of you might call this a no trade zone. Those are areas of balance, but areas of balance do not come equal. What I'm trying to articulate is that regardless of if these are no trade zones or areas of consolidation where the market is just going sideways, there's no volume in the market, we shouldn't be trading these areas. These, in a general sense, all I'm saying are areas in the market where buyers and sellers are interacting with each other. That's the main takeaway, okay? So here, right? The main takeaway is that balance is buyers and sellers interacting, okay? Interacting together, all right? And then imbalance is going to be the opposite. An area of imbalance is going to be um, only buyers or only sellers in that area. All right. So that's an area of imbalance. And then this is an area of balance. Okay. So all of this right here, I could just put a B, right? B for balance, 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 and another B for balance. So now, what's left? The only thing that's left is all of the areas of imbalance. Okay. So that means whenever price is ready to move outside of a range or where buyers and sellers are pretty much happy and interacting, we create areas of imbalance. That's what all of these sections right here are just areas of imbalance. I know this might actually be a little hard to see because, the contrast is not that super duper high between the two colors, but I can fix that in a moment. All right. Okay. So this is an area of balance right here, and then everything else is an area of imbalance. I'm not gonna skip this. Some people might like the satisfying nature of me drawing this. Gives you time to take some notes, gives you time to digest what I'm saying, or if you want to go ahead and skip through until I keep talking, feel free. But just know that I'm right here with you, trying to articulate these concepts to the best of my ability in a way that a lot of people could digest. So just bear with me. So, all right, finally doing the last one. So, what I'm trying to articulate in this video is that ICC makes our money on the creation of the imbalance. Okay. When we're looking at trying to trade ICC or break in retests, we are looking at trying to create our money here, 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 and here. Because in order to trigger this downtrend, what I'm saying is in this area, this is where we do our analysis. This is where our price action is, and there's going to be some interaction that happens here that makes price sell off. And the only thing that could be is a confirmation of a downtrend. So while this looks equal, like I said, this is just supposed to be conceptual. What this is going to represent is that at some point, price might have been trending upwards and making higher lows and higher highs, but then we came down, made a lower low, a lower high, and then this was the confirmation of our downtrend, with this right here being our indication, right? This would be our indication to the downside. This would be our correction phase, and we don't really want to trade this. And then we will go ahead and enter and execute our continuation trade, right? Or our entry right here to make money as price is falling down, right? And we would be entering into this trade. So then because of the confirmation of this downtrend, we would move away from an area of balance, which is basically, let's just kind of say like, we would move away from an area of balance and then create an area of imbalance. And that's where our money is being made. Okay. So where all of this stuff is just equal, like this is just an equal range, imagine there's price action in these areas of balance that are letting us know and giving warning signs that these profitable imbalances that are being created, we can see those coming, and then we can get into trades roughly up here in this region and then make money as we go down to create a new area of balance down there. Okay, so let me see. So I want to go ahead and delete this. So with that said, now what? Okay, we understand this, Romel. Okay, so now what? So the next step in this is understanding why the market moves the way it does. Okay, and it has to do with this idea of fairness. Do you remember when I said this could be considered fair? And then this could be considered unfair? It's just that, like, okay, if you have buyers and sellers interacting here, right? So, case in point, let's look at case in point number one. You have a green line representing all of the buyers, and then we're going to make some red lines representing the sellers. Okay, great. So now in this range between the highs, right? Between the high of the range and the low of the range, of the area of balance, right? We have we have buyers interacting, in the same price levels where sellers are interacting, meaning that buyers and sellers are interacting together. Okay. So they are interacting together, both buyers and sellers. All right. They are interacting. That's and together this just means the same price range. Okay. That's all that means. Together means same price ranges, right? So in this price range between this high at whatever price this is and this low at whatever price that is, we have buyers and sellers interacting together inside this price range right here. That's what that means. So now what? In the area of imbalance, once we see that, okay, bet price is going down, and we go ahead and we shade this in as red. Now what do we have? Below the low of this price range and above the high of this price range down here, right? Now all of a sudden we just created an area of imbalance. Meaning that we just created at this moment in time an area of unfairness. Because only one side was capable of trading in this price range. And which side was that? It was only sellers. Only sellers. No buyers, right? And we can visually see that because there's no green, right? There's no buyers here. Meaning that if only one side is getting some action, basically, if only one side is getting their needs met in this relationship between buyers and sellers, if this is a one-sided relationship, only one person is benefiting from this and the other one the other one is not, then it's unfair and there's an area of imbalance, and buyers are buyers are getting left out. They don't have a fair chance to enter into the market or to get out of their positions if they see price coming down. You can think of this as sellers just bullied buyers. They broke a low, came down to an area of balance, and never gave buyers a chance to get out by creating highs. They never gave them a fair chance. They just bullied buyers, out of the market. It's just unfair market dynamics. Okay. So as the market progresses, right, and we continue to establish new ranges of balance, aka areas where buyers and sellers are interacting and whatnot, then what ends up happening is that justice has to be served. There has to be a stop to the bullying at some point. The market can only move so far for so long in a unfair manner It can only move so long in an unfair matter that it has to correct. And that's what a pullback is, right? So let's think about it like this. We get our, sometimes we might get an indication to the downside. Price is letting us know that it wants to sell, and then it doesn't pull back and it keeps selling some more. It can only do that so many times until a pullback becomes not only healthy, but necessary and required. So now in relation to this downtrend, right? Because this is going to have some lower lows, a high, low, lower highs, lower lows, and all that kind of stuff. In the nature of this downtrend, if there are, in other words, sometimes this area right here between this low that was broken and this high that was created, sometimes this is commonly referred to as a gap in the market, right? And then if you've heard the term they'll even go so far as to call this a fair value gap, because they recognize that this is unfair and unsustainable market dynamics where the market is not balanced and it's destined to get rebalanced. The scales have been tipped too far to the sell side, so then eventually the market comes back to get rebalanced, and then at that point we'll figure out what to do. So what I'm trying to do, what my goal is in this video is like I've already stated, and I'm just saying it again to keep myself on track. I'm trying to explain why the market moves in the way that it does. Okay. And so now where are we? So let's just say, okay, the market gives us new areas of balance, and then it still decides, instead of correcting and being fair, the market decides to give us more areas of imbalance to the downside. Once again, creating a dynamic where there are only sellers. There are only sellers and no buyers. Right? This is all red. Only sellers, no buyers. We can still make some money. Great. But cool. After a couple cycles of this, and I just dropped a very important word for later, cycles. After a couple cycles of this, the market's going to be like, all right, bro, hold up. We can't keep doing this, right? This is when you get to that point in the relationship where, you know, you have to have that conversation about boundaries. Let's go ahead and set boundaries here, right? Like, because one person in the relationship has been getting away with breaking boundaries and having unfair uh, dynamics, or having an unfair dynamic or edge in the relationship. You know, one person has been getting what they wanted, but the other person hasn't been getting what they wanted. So after too many iterations and cycles of this, there needs to be, you know, conflict mediation. There needs to be some counseling. There needs to be a conversation, and hopefully it's a healthy one, where you guys reassess and talk about how we can get back to a steady state where we need to tip the scales back a little bit. Okay. So area of balance. So let's just go ahead and keep drawing this out for a second. Um, because let's just go ahead and think about it. And this is how I teach. It's very analogous or analogous heavy. Analogies heavy, right? Because I want you to just make sense of this. The market is nothing more than just a psychological reflection of prices that people think it should be at, right? So then if you know how people think, you can trade, right? So now, doesn't this make sense? For the first time, we have an area in the market where there are only buyers, right? There are only buyers, right? And then there are no sellers here. This is great. And this is great because they've been bullied so much. But now, this is where we have to just conceptualize and understand a couple things, right? And I'm gonna make another separate video on this, but keep this keyword in mind. What is it? I'm just gonna say like 50% or equilibrium, right? Which is just another place to say happy place, 50%. We meet in the middle, right? Equality, equity, right? Just 50%. This idea of 50%, right? So what I want to get at is, why did we choose, and this, I drew this for a reason. Why do we think we chose to go all the way up to here and target this area of imbalance? How do I want to articulate this? Maybe let's go ahead and go back to pink. Um, sure. All right. Why did we go all the way up and target this area? Right? Like, why was this the area of imbalance that we chose to target over here, and we didn't choose to target this area of imbalance down here? In other words, why did we not just come up to this area and then push down, right? Why instead did we come all the way up to this area before we pushed down? And it's just this concept. Let's go ahead and just stick with the analogy that we were using, right? Relationships. If, let's just say, I'll go ahead and just crap on men for a minute. What if the man in a relationship is constantly doing things that creates a little bit of an unfair dynamic in the relationship, and you as the woman, you tend to be a little bit too submissive or accepting or whatever the case is, and he kind of gets away with things just a little bit too much. And then you guys sit down and you decide to have that conversation down here, right? You decide to have that conversation, and in this conversation, you two decide that he actually needs to not only stop with this behavior, but he needs to also make up for the behavior as well. Like, he did just a little bit too much for a little bit too long, and now in order to, I don't know, regain trust, to regain whatever positive state of being back from his significant other, he actually needs to overcompensate a little bit uh, for for all of the misdeeds or all of the boundaries that were getting crossed. He actually needs to do a lot of work, you know, to get things back better or fair, right? So what ends up happening is that okay, coming back up to a level that should have never been broken to begin with because we never retested the first one that was broken. This can't be enough. This is not enough work. Not enough effort, not enough work, not enough time, not enough anything has been put in to reconcile the wrongs or the boundaries that were broken from way up here, right? So then because yeah, when this was broken and we were at a place of fairness and agreement, you still should have came back up to fix this issue, which is, you can call this issue number one. But now you just created issue number two by breaking another boundary. And and it's like, sure, you could solve issue number two, but now there's a whole nother issue, an overall issue that is wrong, and that's called issue number three. And issue number three is, hey, I need you to not only fix issue number two, but I need you to go back and fix issue number three. And on top of that, I need you to no, sorry, I need you to go back and fix issue number one. And then on top of that, I need you to probably let things start going in my favor, because now issue number three is the fact that I'm mad that not only did you break one boundary, you broke a second boundary. And while I'm mad about those two things individually, I'm also mad about both of those things collectively. So now, not only do you need to compensate, and fix and rectify all of these wrongs that you did, when things come back your way a little bit and I start to come back around, it's not going to be for long, because now, for the next season or stretch of time, I'm going to be not in charge, but there's going to be more energy coming towards me because we have to rectify, all of this. I know that makes sense, right? That's going to make sense to a lot of people, right? Because, relationships are a thing and they're a little, uh, yeah, you know what I'm saying? So anyway, so now let's take this back into just actual trading terminology, just trading dynamics, right? Because of all of the lows that were broken before, still, same thing applies. Coming back up to this level is not going to be enough to attract what? Sellers into the market. Because price could just, like, it's not going to be enough to attract sellers into the market. That's the basic thing I'm trying to say. However, if price comes back up to this area where we started the sales to begin with and everybody made a bunch of money, I really should have wrote that in red, but where all of the sellers made all this money, then perhaps this area up here is enough to attract sellers. So let me actually go ahead and, for the sake of color coding and everything, right? This is where sellers made money. And then So, and this is, let's just say this is where sales started, right? Because let's just say we were uptrending and this was the highest high of a trend, and then we started selling. Cool. So this is where all the sales started. And this is where sellers made a bunch of money. And then they also made a little bit of money here. So another thing we could do is say, okay, yeah, sellers made $3 signs, but then down here, sellers made maybe only what, $1 sign, not three. So they made a lot of money up here, but then they probably only made like a little bit of money down here. Okay. So it might attract some sellers, but it's not going to attract a lot of sellers until we get up to here. So this is just simply called an attractive price, right? For sellers. Now, a very simple rule of thumb has to do with this 50% idea down here. So since I'm kind of running out of space here, let's go ahead and articulate this a little bit higher. Ignore this for a second. It's this idea that, okay, when you have the market creating an area of balance, and now I'm actually going to draw my area of balance a little bit different. So I'll draw, I'll kind of showcase what I mean when I say I'll draw it with a little bit more detail. Okay. And this will be a little bit more of an accurate schematic of how price moves sometimes. All right. So let's just leave it right here. So, all right, where's my area of balance, Romel? Area of balance is going to be right about here, right? And then, boom, that's my overall area of balance here. And then where's my area of balance down here? Overall, it's going to be about right here. Right? Cool. So the market may move in these ways. And so what happened here? All right. So bet price had made a low. There was a low here. And we're gonna start bridging some of the concepts together now. Where so this is tracking our highs and lows. We have a low and a high. Okay. Then in relation to these first set of highs and lows that we marked, we have, let's just call this a equal low. Right? Meaning that this is neutral. It's not a lower low, it's not a higher low, it's just another low. Then we have so this could be anything you want it to be in a way, okay? Then we have a higher high in the market. Then we have a higher low. So now we at least know that we're still uptrending. We have highs, lows, equal low, neutral, a higher high, a higher low. But now we create a lower high. And then because of the break of this low right here, this creates a lower low. Okay. So now, what are our first set of lower lows and lower highs that confirmed this downtrend in this area? It is right here. That's your lower low. Sorry, that's your lower high, and that's your lower low. And then where were the sells executed? The sells were executed at whatever closing price, at whatever the closing price was, right below of a candle, right below this lower low, because this is where this is where all of the sellers got into the market. So this is where we are entering into our trades, ideally. Now, if we miss this, this is a major level in the market. We still can use this area for our indication to the downside right here. And then we can still use this for our correction. And remember, we don't trade this area. And then we can get back in to more entries when price proves that it can close back below and we can make more money, right? And so this is just examples of trades that we can execute. We can execute here for trade number 1 and then here for trade number 2, all right? And what we're doing is we are in an area of balance. I do not like that V. All right. We are in an area of balance, or otherwise known as fairness, right? Fairness. And then if you really want the technical term, we are in an area of fair value. Okay. Right. And in this whole area, this whole big V area, right? Then we create the area of imbalance. The area of imbalance starts here. It starts wherever the area of balance ends. There is no, how do you call it, gaps. It's just when one area ends, another area starts. Okay. So now we start to create an area of imbalance. And that's what this whole area is called down here. From just, I don't want to, because I want to write in this area. So let's just write it over here. Do I have enough space to fit it? Imbalance. Yep. Right. An area of imbalance, otherwise known as unfairness, or a fair value. And this is not specifically like what the mainstream traders would call a fair value gap, but in other words, a fair value a fair value gap, just in a very basic sense, right? Or in it's an area of unfair value, okay, or something like that. You maybe call it unfair value, okay? So that exists from where the low of the balance is, like from where the low of the balance area starts all the way to the all the way to where the high how do I want to say this? It's the same thing. Um, I just don't want people to get confused. But anyway, it's the low. The low of one region of balance and the high of the next region of balance, right? So if this is just with neutral color, we will go white. If this is the low of this balance area, and then this is the high, then that means this down here, this is the high of this new area of balance, and then this is the low of this new area of balance down here, right? So that's just what I'm trying to articulate. So wherever these areas end, that's where these areas of imbalance begin. So why did I come up here and start trying to draw and articulate all of this? It was because I needed to explain the magic of 50%. Let me go ahead and do this in yellow. And this is going to be another video, but this was just kind of all encompassing, right? But the magic of 50%. All right. If you are a buyer, right? If you are a buyer and you want to go and purchase something, right? What is going to motivate you to purchase something? So let's just say you go into a store, right? You go into a store, and inside this store you have something that is inside this store. Let's just say everything is only what, 20% off. This means that if you spend $100, it would actually get slashed and you would only spend $80. Now, that's great if the numbers are really big, right? But how much does 20% off really matter if we're only going into the store to spend, I don't know, $10, right? And then next thing you know, that gets slashed. And instead of spending $10, we're only spending 8. So you're saving $2. So while there's still savings, unless you have a lot of money, you don't really see a lot of savings reflected in your purchase. So you're not really motivated to go and buy something if the sale is not attractive. Maybe a more less attractive sale would be something like 10% off, right? But now, let's just say you go to the store and you're going to a thrift store, or it's a holiday, or whatever the case is, holiday season, it's Christmas time, and I don't know, or it's Black Friday, and you're actually able to get things for 50% off, or even 75% off, or things are on clearance and they're 80% off. When you go into a store with money, and you see these prices, you are then what? You are a motivated buyer. You are motivated to buy just for the sake of the fact that you're getting a deal. 50% is that magic number where buyers get motivated to buy even if they don't even need to, right? Is if things are 50% off. 50% off is equal to buy one get one free, right? If you've seen that before, buy one get one free. That is the same thing as 50% off. Because if you buy one thing, you can for buy one thing, you can get two for the price of one. If you if you did this in reverse and you got one, or whatever the case is, no, you got two, and then you divided that in half, right? Um, you divided that in half, or whatever the case is, then that would equal one. So it's 50%. 50% is buy one, get one free. It's just the way it's worded is going to motivate you to buy even more. So the point is that once we're at 50%, just accept this as an objective truth that this is the price where buyers are motivated to buy. Now, what about a seller? It's the same exact logic. So now let's say you are somebody who, let's just say you're in the resale business and you bought something for 75% off, right? Or whatever. Like you bought something and you don't have money, but you want money. So instead you just have a box. Okay. You have a box of goods or something that you're trying to sell. And then you go to a market. It could be a store or whatever, or the freaking stock market, foreign exchange market, the what we're trying to learn how to do. You go to a market, and here at this market, you are trying to get the best price. And since you are a seller, right? Since you have something to sell, you are a seller. The only way for you to get the money is that you are looking for the best price, which means you are also looking for the highest price that you can get for your stuff. Okay. And so, with this understanding, imagine, let's take all of this right here and relate that over to everything that we're doing here and here and all of this. Okay. So when you have a seller, let's just say, okay, bet you got people down here who they have goods. And what good do they have? Okay, well, it's very simple. They have X amount. The people down here, um, and actually here, let me see this. The buyers, right? Buyers down here. Maybe I should have did these in different colors, but anyway, buyers have X amount of whatever the asset is. The asset could be, if you trade foreign exchange or whatever, your assets, I don't know, it could be X amount of oil, gold, right? or X amount of NQ. If you trade futures or NAS 100, it's the same thing, right? You have X amount of silver, X amount of Apple stock. I don't know the ticker for Apple, or AMD, right? AMD stock or GameStop or whatever it is. Or if it's crypto, you have X amount of Bitcoin, X amount of XRP, whatever it is, X amount of whatever you are trading, right? X amount of etc. The asset class, or not the asset class, but the X amount of the asset. You have X amount of blank, right? At what price? At such and such price, at X price, at X price. Okay? Bet. So now, based on where sellers sold their goods, if we want to get a pretty decent price, we have to sell it to the people who sold this good to begin with. Does that make sense? So we have people who are buying it, and we want to bring this up, right? We want price to go higher. But then you have sellers over here, they want price to continue going lower, right? So with this said, we know that they want to sell up here because we can visually see the sellers. This is what our technical analysis allows us to do. We can visually see where the sellers are in the market, right? We can visually see sellers. Okay. We even see the time and the overall prices where they created and broke supports. We see all of this detail. We can literally see the sellers in the market up here at this area. And then we can literally see the buyers. This right here is known as manipulation. We won't get too much into this, but it just in case, I'll make a future video on this. Price comes down and grabs liquidity, right? I'm not going to get into that. And then it comes up, and now we can literally see the buyers in the market here. Why? Because a higher low was made, and then when price came up and closed above this high right here, a higher high was made before we actually finish getting to the promised land, if you will, before this actually finishes getting up to whatever higher prices it's going to get to. As soon as we get price closing here, we know that, okay, bet buyers are in the market. They've just accumulated and they just confirmed an uptrend. So they're going to push the market up. So now there's a war, right? I use a lot of analogies, and I think of trading a lot of times as like a gang war. You have a lot of buyers down here, and then you have a lot of sellers up here, right? You have Bloods, and then you have Crips, right? You have, however you want to think about it, you have a war going on. You have the North and the South, whatever it is, doesn't matter. So this is a war always happening between buyers and sellers, or in other terms, between the bulls and the bears. And and if you ever heard that term bearish, right? This is just people who desire the market to go down. And if you ever heard the term bullish, these are people who just generally desire the market to go up. And these two start to get into sentiment, market sentiment. What is the sentiment? The feelings, the overall ideas or feelings about uh, what direction the market should go, right? Where you start getting into words such as bias, market bias. What is my bias and why, right? So there's different types of analysis. This right here that I just wrote, this is about sentimental analysis. Everything that we just did up here, tracking the highs and the lows and the breaks and all that stuff, that is technical analysis. Technical analysis. And then when you have freaking Donald Trump, you know, and wars, happening, and tariffs in the market, and all of this other stuff, that is called fundamental fundamental analysis, right? And a simple way to word that up is just say that's real world news. And I should probably write this somewhere else because I'm gonna actually use this space to make a point. But that's real world news and events. Fundamental analysis is real, and not Andrew Tate's real world, right? And whatever his stuff is. This is just literal real world news, events, and data. Okay? Like legit economics and politics and all of those things. Okay? That's fundamental analysis. So these are the things that can move the market, right? You got just general people, technicals, a way to analyze it on the chart, and then you got just sometimes these get totally trumped by what happens in the real world. So anyway, doing a lot of talking around, literally around the main things that I want to talk about right here, okay? Which is the magic of 50%. So back to yellow. We visually see that sellers are up here. We see that buyers are down here. We know buyers want to take the market up, and we know sellers want to keep dropping the market down, right? So where will they stop? Where will they meet? Where will they agree? As an objective truth, right? Keep in mind that this up here is a objective truth about market psychology, game theory, just people's understandings of like the rational and irrational decision making of buyers versus sellers, right? That this right here is just an objective truth. So the objective truth is that somewhere there's going to be a 50%, a 50% line. So I'm eyeballing it, right? Somewhere between this area that was broken and this area that was created is going to be 50%. Okay. This is the bare minimum for buyers, right? This is the happy place. This is the equilibrium. I'll just write it over here. This is the bare minimum price that buyers are happy to sell at. And this is the bare minimum price that, no, hold on. Let me make sure I'm stating this right. This is the minimum price that buyers want to sell, right? And then this is the, wait, yeah, hold on. It's a little bit of a tongue twister, I'm not gonna lie, okay? Because buyers sell. So this is the bare minimum where buyers sell. So then that means this must be the bare minimum where sellers buy, right? Or where sellers get into the market, not necessarily buy. But yeah, where sellers get into the market and they buy these goods, but they short the market or whatever the case is. Um, or okay, I'm getting a little confused, so I just don't want to confuse anybody with the way that I'm wording this, but hopefully you get what I'm understanding. Equilibrium is the happy place between buyers and sellers. So if we have goods until we hit 50% of the area, buyers are not going to be thinking about buying. They're not going to be thinking about getting rid of or selling their goods back to the market, right? They're not going to do that. And then sellers, they're not going to think about getting into the market or shorting it or whatever the case is, right? They're not going to think about, oh, sellers are not going to think about buying these goods from the buyers at these prices until it gets up to this level. So 50% is just the magic number. Very often what you see is price will hit it and essentially trade back below it and go back down. Now, sometimes depending on how the market plays out, right? You see that there are micro ranges that were created between this area and this area, right? So this is another fair value gap in the market. Why? Well, because from a very technical perspective, this is an area where there were buyers and sellers, meaning that while we have major balance areas, we do have a little mini balance area right there and another one right there, meaning that this in its own right is a micro area of imbalance. And we see how it starts right at around 50%. So now the question is okay, bet, is this the highest price that buyers can sell at? Because that's what they ultimately want. It's the highest price. So while they might be satisfied in getting filled here, they actually might want to take price up a little bit higher to this equilibrium, to this 50% of this specific range up here, which might end up overall being a 61.8. And that's a golden fib ratio and blah, blah, blah. There's a lot of other things that we can pile into this together to create confluence. And the best technical analysis will have confluence, meaning that you will have multiple, how do you call this? You'll have multiple concepts trading concepts aligning at the same price, right? And so overall, it's a little bit too much to get into. I think this video is already what? It's an hour long. We're doing a pretty good job. I'm not gonna lie. I'm quite proud of myself. But anyway, it's just this idea that, okay, price is not high enough for sellers to get out the market. Now, I just gave you a pretty general good synopsis from a market perspective and psychological perspective as to why back down here in this analogy, why this area right here was not enough for who? For the buyers that were right down here in this area that brought the market up. This wasn't enough because now in relation to this area up here and this area down here, and we just kind of eyeball it, we got a 50% kind of something going on like around here. If we know that this is 50%, then anything being executed right here is not enough to what? Motivate buyers to sell. So a seller, if there's nothing to sell, right? Buyers meaning like, okay, let's think about this. If the people holding the goods don't want to sell, then that means there's nothing for the sellers to buy, in a way, is what I'm trying to say. Or like there's nothing for them to interact at. If buyers are still holding on to their goods at these prices and there's nothing available for the market to take from them because they don't like the prices, then price will keep going up, right? So this is just, its price is not high enough to motivate the holders, the buyers in the market, to get rid of their goods. And price is too low, it's also not high enough. It's not an attractive price for sellers because sellers want to sell the market above 50% and buyers want to buy it below 50%. I know this could be a little bit confusing sometimes because it's like the whole idea is that, and it all boils down to this principle, okay? This is why I say it's confusing. I just drew a down arrow that's green, right? And I'm drawing a up arrow that's red. How does this make sense? Doesn't red mean sell, Romel, and buy means buy, and why are they like this? It's because it's the simple idea, simple principle that we know we should buy low and we should sell high. And this very dynamic, even though it is very intuitive, it gets people so confused. Sometimes it even like starts to trip me up at times. But in a general sense, that's what we should do. Because you see how this was green up here and this was red? Okay, bet. So the sellers, meaning that these are people who had already bought, and so the only action that they can take is to sell. They're already in the market. These people are these people, right? Because they're already holding the goods. And the only thing that they can do, the only button that they can press now is sell to get rid of them, right? That's why they're red. Then you have buyers. These are people they actually don't have any goods, right? They want this. They have money. These people have goods. So so it's like, okay, when the price comes up high enough, these people will give their goods back to the market, right? Which is this overall idea and concept. They'll give their goods back to the market at the best or highest prices that they can. And then the people who don't have the goods or whatever the case is, like, they will want to get into the market at that time, right? Or short the market if there's no demand, or they'll keep it going up if there still is demand. It's all about supply and demand. Okay. So it just depends. It'd be a little confusing. I'm not gonna lie. You know, when we try to explain it in these ways, these technical ways, it can be a little confusing. So if whichever one floats your boat, right? The boyfriend girlfriend dynamic, I think that one was a very good analogy, right? Where boundaries are being broken over and over, and the boyfriend has to overcompensate and to deal with issue number one and number two and number three, because like issue number three is just because there had to be an issue number one, number two. We can understand that, right? And then it's simple, right? We understand how the market has to flip and start going her way more because the dude, it was going his way for too long, right? And so, but now hopefully you understand why the market did not stop here. It wasn't enough, and it had to go up to deal with the first levels that were broken, or the first area of imbalance up here. Hold on, the first area of imbalance, because I kind of want to get this big 50% line out the way, but now I'm erasing so much stuff. So anyway, we had to come up and get this out the way because it was above 50%. But now even here, like I was saying, there's micro levels. So let's just say roughly this is 50%. In this example, it decided to come up to the highest price, which was where all of the cells started, and tap this area and sell off of it. And sometimes this is simply just called a imbalance play. Price goes up and it taps an imbalance, aka wherever we sold before, and we broke these lows, we go up for the retest. Now you start to see the language coming in. Break and retest. We broke these lows and we never retested them until here. And then now we can get into sells here, especially once they confirm, because the market is going to show us that it was uptrending and then decided to create a downtrend because we created a lower high in the market and then a lower low, and so on and so forth. And we'll see this inside this big area of balance to allow us to enter into the market, justify our position, and make money on a short to the downside, right? And same thing, and so on and so forth. So now not only can we trade these levels, like not only are we making money here and here and here and here, but now what happens when we looking at the market from a big overall perspective? Now the market goes up and breaks this high, creating a higher high region, and we're starting to look at a more long-term dynamic. Then the market comes down to create a higher low region of prices, because in relation to these lows down here, these lows are higher. And now we have a indication, a correction phase that we don't want to trade, and then a continuation phase where we can make money, but now we can hold our trade for a longer period of time, because now we might start making more areas of balance and trending up for a long period of time. So the amount of money that we're going to make here is just that much more, especially if we could enter somewhere in here, then here, and then, and then we enter here, and then we might can even get a breakout, another entry here. There's a lot of potential areas to get into the market when you can be sensitive to know the market cycles, and you understand balance and imbalance. So that way you not only can capitalize on all of these little trades, but you also have good ability. Understanding balance and imbalance gives you a good ability to develop the proper sentiment that you need to have, the proper bias that you need to have to know whether you need to buy or whether you need to sell, right? So if we found ourselves in this sort of dynamic here, and you see that we once were at a high price and now we're at a low price, we should be anticipating looking for trades to go higher because of where we are relative to recent market structure, right? We are at lower prices. So we want to always be cognizant that we want to buy at low prices and sell at high prices, and we might be able to get a trend that confirms to take us up to an equilibrium point or anything like this. Is just, this helps you develop better market sentiment, better understanding of what's going to happen, and we'll get into this concept in another video. So hopefully this was helpful for you guys. Nice little hour and 20-minute lesson about just the concept of balance and imbalance and why the market moves how it does. And once we start to connect all of the dots, right, we start to do the technical analysis and the sentimental analysis. Really, that can get you such a long way, to the point to where you'll be able to make all of the money that you would need to make if you just understand balances, imbalances, and how to execute these trades before these areas are created. So cheers. Give me feedback and let me know how you like this video. Until the next one.